Hi everyone, Rich Saperstein, Chief Investment Officer of Treasury Partners. I'd like to talk about our outlook for the stock market in 2026. It's a narrow stock market dominated by the Mag 7, but you can see how over the last 5 years, I'm going to also show you a chart on 10 years, the growth of Mag 7 has dominated the returns of the stock market. We're overweight the large cap tech sector. We continue to believe that that is a sector to have exposure to. You can see how over the last 10 years, it's dominated the value stocks. We expect a broadening out from growth to value, but we would not abandon the growth exposure in portfolios. There's talk about how overvalued they are. Here's a chart showing the comparison with 2000, when, remember, we had the tech crash. PEs today are significantly lower than back in 2000. In terms of why these stocks are dominating, look at the earnings growth compared to the 493 stocks over the last 3 years. They've dominated the growth. The growth has enabled investors to continue to buy these stocks and drive up the prices. But what we try to do is look at the operating cash flow as compared to just the earnings. And if we look at the earnings growth over the last 6 years of these 4 companies, it's up dramatically. Here you can see Microsoft up 280% in the earnings growth, and the stock price is up 293%. So what we're seeing is that the stock prices are going higher, but at the same time, the operating cash flows that they're generating are moving higher at the same pace. In fact, with Amazon, the cash flow has grown quicker than the stock price. If we further go to what these companies are doing for efficiency, their revenue per employee is going up very significantly. We expect that to leach into other areas of the stock market as there's more adoption of AI throughout different sectors and businesses. So we're gonna look for greater efficiencies, higher operating margins, and low and higher revenue per employee throughout the market. I also want to reflect the difference between cash flow of the large cap tech versus the non-tech. Large cap tech are delivering much higher levels of cash flow to the bottom line than technology stocks. The wild cards in our outlook for the market, which we think will be positive this year for the 4th consecutive year of growth. Number 1 is going to be the Fed. New Fed chair, we think, will be accommodative, but we are uncertain as to what they're going to do with the balance sheet. If Warsh goes in, then all likelihood he may stop the quantitative easing that Powell recently restarted, meaning rather than buying bonds from the market and injecting liquidity into the system, he will do just the opposite, allow bonds to roll off, thereby pulling liquidity out of the system. And finally, this is a big deal. CapEx, the 100% depreciation or expensing of the cost of construction. Will we see CapEx start up and new factory build-outs? We're seeing this chart. It's starting to increase. Depending on the longevity of this, it could have a very big impact on the economy. So our expectation is for another positive year in the stock market, rising earnings, rising stock prices, and we are not concerned about the supposed overvaluation of large cap tech.